Okay, so last time we solved the investor's problem. So investor knows vector mu, the expected returns of all the stocks in the market. Investor knows variance covariance matrix that summarizes the risk information of all the stocks. And investor asks, okay, I want at least 1% expected return from my portfolio. What portfolio should I buy to minimize the risk of my portfolio? The problem looked like this. Investor is minimizing the risk of his portfolio subject to the expected return of the portfolio being at least mu bar. Mu bar is the minimal acceptable or minimum required return for the investor. And we analytically solved for the optimal portfolio. And the solution looked like this. This is the optimal portfolio W equal to V inverse lambda 1 mu plus lambda 2 1. This bold letter 1 is the vector of 1s, 1, 1, 1, 1. And lambda 1, lambda 2 are given by this. Lambda 1 and lambda 2 are both given by ABC and mu bar. Here, ABC are given by mu and V, just environment variables. And then we were in the middle of Excel exercise to draw this efficient frontier using this analytical solution. To refresh your memory, we have only 4 companies in this example: GSK, BP, Unilever, Rolls-Royce, and then this is our mu vector, which we named as M. And this is our variance covariance matrix, which we named as V. We need V inverse, so here we computed V inverse using M inverse function, and we named this region as V inv. We need a vector of 1s, 1, 1, 1, 1. So this is the vector of 1s, and we named this region as 1s. And we computed A, B, and C. A is mu times V inverse times mu. B is mu times V inverse times vector of 1s. And C is vector of 1s times V inverse times vector of vector of 1s times V inverse times vectors of 1s. So let me call this cell A. And let me call this cell B. I want to call this cell C, but unfortunately Excel doesn't allow to use C as a name because C refers to the entire column in Excel. So instead of C, I'll name this cell D. Okay? And the investor's problem can be solved for a variety of mu bars. So the investor can say, okay, I want at least 0.1% from my portfolio. Or this is the investor's choice, right? The investor can say, okay, I want at least sorry. The investor may say, okay, I want at least 2%, 3%. If investor requires very high expected return, then he cannot make the risk of his portfolio very small. If he's okay with very small mu bar, then he can make the risk very small. Okay? There is high return trade-off. And we are going to compute lambda 1 and lambda 2. Lambda 1 is C mu bar minus B over AC minus B squared. So that's our D times mu bar, yeah, minus B, that's the numerator, over A times C minus B, or A times D minus B squared. Okay, that's our lambda 1. And we are not using any matrix function, so we can simply press enter. And lambda 2 is A minus B mu over AC minus B squared. A minus B times mu bar over AC minus B squared. Yeah? And then, given lambda and lambda 2, we can get the optimal portfolio, which is V inverse times lambda 1 mu plus lambda 2 ones. So I choose this 1/4 region, click on the function bar, starting with equal, I type V_inv. Okay, this is matrix multiplication, so I should use mmult function, matrix multiplication function, to multiply M inverse and lambda 1 times the vector of mu vector, which is transpose of M, plus lambda 2 times vector of ones okay? So that's that. The inverse times lambda 1 times vector mu as a row plus lambda 2 times the vector of ones. Control Shift Enter. And you see the same numbers. And this is because our formula expresses the optimal portfolio weights as a column, not as a row. So yeah, we have to transpose the whole thing. So I click on our equation and I add transpose. And Control Shift Enter, and this is the portfolio weights. To make sure, let me sum up these portfolio weights to make sure that the portfolio weights sum up to 1. Okay. And then once we have portfolio weights, we can compute the risk of this portfolio using our usual risk formula. So the standard deviation of this portfolio is portfolio weights times variance covariance matrix times portfolio weights again. And we take square root, Control Shift Enter. This is the standard deviation of this optimal portfolio. And we solve this problem for a variety of mu bar, because the minimal acceptable expected return depends on the investor. And okay, and these are the risks of these optimal portfolios. The expected returns are the same as the first column. So I copy and paste this first column here next to the standard deviations. And I can plot these two columns. So insert scatter plot. Okay, so this is standard deviations and expected returns using our analytical solution. Okay? Good. Let's move on to the next topic. The next topic is, this was the feasible set and efficient frontier we produced by generating 10,000 random portfolios. What if we have risk-free asset? Efficient frontier looks like a hyperbola. It is a hyperbola when there is no risk-free asset. But suppose there is a risk-free asset. Let's make this GSK risk-free asset. Risk-free asset means what? The variance is 0. And its covariance with the other assets are all 0. Now GSK is risk-free asset with risk-free rate 0.64%, and you can see that the efficient frontier is now straight line. This is our next topic. Okay? Okay, so the horizontal axis is the standard deviation, and the vertical axis is the expected return. And we have GSK, BP, Unilever, and Rolls-Royce. Some stocks are more higher risk, higher return than others. And by combining these four stocks, we can achieve any risk-return combination in this efficient frontier. This is hyperbola. The efficient frontier, the border is hyperbola without risk-free asset. And now, suppose we have risk-free asset with risk-free rate equal to RF. Well, in the Excel demonstration, I changed the GSK into some other risk-free asset, but let's say there is the fifth asset, which is additional asset, which is risk-free. Yeah? And then the efficient frontier, so draw a tangency line with some tangent point. Draw a straight line which is tangent to this hyperbola. And now efficient frontier, the feasible set becomes the area below this line. Let me explain why. When you combine assets, for example, suppose you combine Rolls-Royce and BP, 50-50. Your portfolio puts half of your money in Rolls-Royce and the other half in BP. The achieved risk-return point is not in the middle. Why? The expected return is exactly in the middle, but the risk is not in the middle. Right? Because there is covariance. Covariance information is not in this diagram, but for the portfolio risk, covariance risk is also important, whether BP and Rolls-Royce are very much correlated or not so much correlated. So usually the achieved point is more to the left. However, if you combine some risky asset and risk-free asset, then achieved points are in the middle. Depending on if you put lots of your money, if your portfolio weight for the risk-free asset is high, then the point will be very close to this risk-free asset point. Risk is 0, and the return is RF. If your weight for GSK is high, then the achieved point will be close to GSK. But anyway, the achieved point when you combine, when you mix risk-free asset and GSK, the achieved point comes in the middle. Similarly, if you mix this portfolio and the risk-free asset, the achieved points will be between these 2 points. So this tangency point will be achieved by some mixture of these 4 companies' assets. So there's particular portfolio. There's a particular portfolio that achieves this tangency point P. Let's call that portfolio tangency portfolio. And if you mix this tangency portfolio, risky portfolio of these 4 companies with the risk-free asset, you will achieve these points on the tangency line. So these points can be achieved by mixing the risk-free asset and the tangency portfolio P. If you short sell the risk-free asset to buy more of the tangency portfolio, then you will achieve points on this straight line beyond the tangency point. So these points can be achieved by short selling risk-free asset to buy more tangency portfolio. And because you can combine this risk-free asset with any risky portfolio, basically the feasible set becomes this area below this straight tangent line. Okay, so this is now new efficient frontier. Any question? So far so good. Are you with me? Okay. So that's the implication of the Markowitz mean variance approach. So let's summarize that implication. With a risk-free asset, the efficient frontier becomes a straight line with intercept equal to the risk-free rate, and it is tangent to the hyperbola. Yep. And this is the mean variance. This is the implication of Harry-Markowitz mean variance theory. Now, William Sharpe, another Nobel laureate in finance, he moved one step further. Based on this theory, he took one more step, and he's the father of this, well, one of the founders of this well-known finance theory, capital asset pricing model. So we'll move on to that. Starting with one theorem. This theorem is going to be the base of the capital asset pricing model, CAPM. And this was shown by William Sharp in his 1964 paper. And the following is the theorem. P is the tangency portfolio. P is the tangency portfolio. So this one, this portfolio, a portfolio of these four companies that achieves this tangency point. Let's denote by RP the return on the tangency portfolio. Let's denote its expected return by mu p. And let's denote its risk, standard deviation, as sigma p. And let's denote by RF the risk-free rate. So, to refresh your memory, we have hyperbola, risk-free rate, tangent point. Let's say the risk is sigma p, expected return is mu p. That's our notation, yeah? And the theorem starts here. Then, for any asset J, the following equation holds. Mu J minus the risk-free rate equal covariance between the return of this asset J and the tangency portfolio divided by the variance of the return on the tangency portfolio times the expected return of the tangency portfolio minus risk-free rate. Here, this is mu j is the expected return of this. So pick any asset, GSK. Let's say J is GSK, okay? So mu j is the expected return of GSK. And if you subtract risk-free rate, that's the expected excess return. Expected excess return or risk premium of asset J and this part is again the expected excess return or risk premium of the tangency portfolio. This is the theorem that becomes the base of CAPM. Now this equation is very important in the history of finance because this equation completely changed people's view of risk. I mean, risk is a tricky word. I mean, risk is a very ambiguous word. People have different image of risk, and this equation changed people's perception of risk. But before explaining, so I want to give more intuition about this, more intuition of this equation. But before that, let's do the painful part, I mean the proof of this theorem. And then after the proof, I'll give more intuition of this equation. Okay? Proof. Okay, so consider a small alternation to the tangency portfolio. So there's a hyperbola, there's risk-free rate, risk-free asset. We draw a tangent line. The tangency portfolio is the point that achieves this tangent point P. We start with that, and let's alter that portfolio a little bit. The portfolio weights 1, alpha, and negative alpha. So portfolio weights 1, portfolio weight 1 goes to the tangency portfolio P. Let's say alpha is a very small number, 0.001. And the portfolio weight alpha goes to some asset J. Let's say GSK. So to get extra cash, let's short sell some of the risk-free assets. So portfolio weight negative alpha goes to the risk-free asset. Their returns are RP, RJ, and RF respectively. Okay, imagine some small number for alpha. We start with tangency portfolio, and we mix a little bit of asset J by getting extra cash from short selling of risk-free asset. The return of such a portfolio, let's denote it R alpha because it depends on alpha, how much asset J you add. And this return is very simple. Portfolio weights times returns, the weighted average of the returns. Okay, portfolio weights 1 times RP plus alpha times RJ plus negative alpha times RF. This is the weighted average of these individual returns. What is the expected return of this portfolio? Well, we take this expectation of this line, then we have mu p plus alpha times mu j minus r f. Because, yeah, expectation of mu p, rp is mu p, and the expectation of rj is mu j, and rf is not random. So, yeah? Okay, how about risk? The variance of this portfolio the variance of R alpha is the variance of Rp plus alpha Rj minus alpha Rf I just substituted this inside the variance. This part is not random. So it doesn't matter to the variance. I mean, the constant doesn't matter to the variance. If everyone in this room wears shoes of the same height, that will raise the mean, but that won't change the variance because everyone gets higher by the same amount. Yeah? Right. And then, what is this? So here we use the variance formula. Variance RP plus, can anyone say the rest? Two alpha, and I think I heard it. What's variance? Yeah, thank you. Plus alpha squared variance of RG. Good. This is variance formula. Yeah, just in case you forgot the variance formula, I put the link to a YouTube tutorial video that explains the this variance formula. So if you forgot, please watch it. It's like just 10-minute video. Okay, so let's denote this as sigma p squared. Covariance between the tangency portfolio and GSK is denoted as sigma pj. And the variance of GSK is, variance of asset J is just sigma j squared. So that standard deviation is sigma p squared plus 2 alpha sigma pj plus alpha squared sigma j squared and the square root of that. That's standard deviation. Okay, we start with tangency portfolio. We mixed a little bit of asset J and risk-free asset. And the return of such a portfolio is R alpha. We computed the expected return of such portfolio. We computed the standard deviation of such a portfolio. Let's compute the ratio of the changes in the risk and the expected return. When alpha deviates from 0. Now, what do I mean by that? So again, the horizontal axis is the standard deviation. The vertical axis is the expected return. And here's the tangency portfolio. Risk is denoted as sigma p. Expected return is denoted as mu p. When alpha is exactly 0, you have this tangency portfolio of these 4 companies, GSK, BP, Unilever, and Rolls-Royce. When alpha is positive, let's say 0.001, you put a little bit more asset J by getting some cash from short selling of risk-free asset. If alpha is negative, maybe you move in this direction, you're short selling asset J and you're buying a little bit of risk-free asset. So when alpha deviates from 0, the achieved point of risk-return combination smoothly deviates from this point P. And what we want to compute is the ratio of the changes of the risk and expected return. So mathematically, we want to compute this. The change in the expected return of this portfolio divided by the rate of change in risk when alpha changes from 0. Okay, so graphically, slope of this change. It's not very hard. We already got mu alpha. So we can easily differentiate that with respect to alpha. So this is our mu alpha, and alpha appears only here. So if you differentiate this with respect to alpha, we only have mu j minus rf. What about sigma alpha differentiated by alpha? This is the expression for sigma alpha, right? So if I differentiate this, it's going to be 1 over 2 to this 1 over 2 comes in front, and then this entire expression to the power minus 1 over 2 times the differentiation of the inside of this parentheses, which is, so if I differentiate this expression inside the parentheses with respect to alpha, I have 2 times sigma pj plus 2 alpha sigma j squared. Do you agree? If I differentiate with respect to alpha. Good. Let's use this. Sorry, this but it didn't fit. Okay. And then we and we evaluate this alpha equals 0, right? So when alpha is 0, 1 over 2 sigma p squared to the power minus half times 2 sigma p j equal sigma pj over sigma p squared. Sorry, just sigma p. We are almost there. Now, okay. The rate of change, the ratio of changes is equal to, it's just the ratio of this and this. So it's just uj minus rf over sigma pj over sigma p. Now, we started this We started with the tangency portfolio. So here's the trick. We started with this tangency portfolio. When alpha is 0, you are here. When alpha deviates from 0, you deviate. But guess what? This point P is the tangent point. So it's actually on the efficient frontier, the straight line. And because it is on the efficient frontier, when alpha deviates from 0, you cannot go this way or this way. The feasible set is below this straight line. You cannot go above this straight line, which means that when you deviate, when alpha deviates from 0, you can only go either this way or this way. So the slope, the rate of change, the ratio of these changes in risk and return should be actually equal to the slope of this efficient frontier. Does that make sense? Okay, let's do that. This is the ratio of changes in risk and return and this should be equal to the slope of the efficient frontier The ratio of changes, we already computed. It's mu j minus Rf over sigma pj over sigma p. The slope of the efficient frontier is very easy. It's mu p minus Rf divided by sigma p. So that's mu p minus Rf divided by sigma p. And these two should be equal. So we have mu j minus Rf. So these two should be equal. So we have sigma pj over sigma p squared times mu p minus R F QED. Don't ask me what QED means. I don't know. It's Latin. Please Google it. Right. So let me give you a little bit of intuition or a hint of why this equation changed people's view of risk. I'll give you more intuition in the next class because this equation is very close to the CAPM equation and the intuition can be better given once we have the CAPM equation. Now, the left-hand side is the risk premium of asset J. And obviously, the high risk, high return principle says that if, well, wait a minute, before that, let me give you the older image of, I said this changed the people's view of risk. So let me give you first the older image of risk, okay? So here's the older image of risk. Or the image of risk of, let's say, asset J. And the older image was nothing but the standard deviation. Okay, standard deviation, or equivalently variance. of the return on asset J. So let's say there is asset A and asset B. Asset A is currently 100 pounds, and there's 50% chance of paying 120 pounds. There's 50% chance of paying only 90 pounds. So the return is either positive 20% or negative 10%. The expected return is the average of 20% and negative 10%. So expected return is 5%. And here's another asset, asset B, which is also 100 pounds. And for asset B, there's 50% chance of paying 150 pounds. And there's another 50% chance of paying only 60 pounds. So the return is either positive 50%, very high, or negative 40%. The expected return is the average, so the expected return is again 5%. Now the old image of risk of an asset was the standard deviation of payoff. And according to that view of risk, which one is riskier? B is riskier. B has more variability than asset A. Do you agree? Do you agree that the standard deviation of variance of payoff is larger for asset B than for asset A? So this is riskier. And because this is riskier than asset A, because asset B is riskier than asset A, the expected return can't be the same. Price should drop. And if price drops, the expected return goes up. Because the expected return, remember, is equal to the expected payoff divided by the current price. So if the current price goes down, the expected return goes up. Yeah? And because asset B is riskier, the payoff has larger standard deviation. The expected return can be the same as asset A. The price should go down so that asset B is higher risk, higher return. This is the old image of risk. Now let's go back to this equation. The left-hand side is the risk premium of asset J. If asset J is very risky, the risk premium should be high. If asset J is safe, then the risk premium can be small. That's high return, high risk, high return principle. Okay, the left-hand side is the risk premium of asset J. This should be large if asset J is risky. Let's look at the right-hand side of this equation. When we look at the right-hand side of the equation, this part doesn't have any J. This part doesn't have any J. The only thing that includes J is this. Now, is this the standard deviation of asset J? Not quite. It is the covariance, asset J's covariance with the tangency portfolio. And the covariance is equal to the standard deviation of asset J times standard deviation of the tangency portfolio times the correlation coefficient between asset J and the tangency portfolio. So okay, we see the standard deviation of asset J But on top of that, we have the correlation coefficient between asset J and tangency portfolio, which means that even if the standard deviation of the return of asset J, GSK, is large, if its correlation coefficient is, for example, 0, even if sigma j is 0, even if sigma j is very, very large, which means that the payoff of GSK is very uncertain, can be very large, can be very small. If the correlation coefficient is 0, then the right-hand side is 0. So the left-hand side should also be 0, which means that the GSK's expected return is exactly equal to the risk-free rate, the interest rate of the UK government bond. If GSK's correlation with the tangency portfolio is negative, then the right-hand side is, if rho GP is negative, even if the standard deviation of GSK is very large, the right-hand side is negative. The left-hand side, this part is usually always positive. So the right-hand side is negative if the correlation coefficient is negative. The left-hand side should also be negative, which means that the GSK's expected return is smaller than the risk-free rate, interest rate that you can get by buying risk-free asset. At first glance, this is very strange. I mean, this means negative risk premium. And investors are okay with negative risk premium only for things like insurances. If you think of insurances like life insurance, cancer insurance, fire insurance, car insurance, you pay a lot of premium. If something bad happens, you get a lot of payment, but the probability for that is very small. So usually, if you compute the expected return for your insurance, it's the expected return is very low, lower than risk-free rate. Expected return is usually negative. But it's okay because it's insurance. And but GSK doesn't seem like buying GSK's stock is insurance. So it's really strange. Even theoretically, it is very strange that return or expected return of something like GSK's stock can be smaller than the risk-free rate. But I'll give you more intuitions, and it will be clearer in the next class why this can be the case. But giving that intuition is easier once we have the CAPM equation. And this equation is already very close to CAPM equation. So in the next class, we derive the CAPM equation and give you more intuition of this. For today, for the rest of today's class, I'll give you R demonstration.